Yeah. So opportunity zones are obviously near and dear to my heart. Which, full transparency, we did launch our opportunity zone fund in the spring of last year to focus on our co-living market segment here in Oakland and Berkeley. But before that, what really intrigued me about opportunity zones was really the story behind it, as well as what I feel is key to our strategy here at Revive and kind of our thesis, which is revitalizing communities in primary and secondary markets. And it actually has a story that a lot of people aren't aware of. The founder of Napster was actually helped drive some of the initial legislation through the Economic Innovation Group. It was a nonprofit that he helped formulate with a stud list of policymakers. He got Tim Scott from my home state of South Carolina, Cory Booker of New Jersey, to formulate this bipartisan legislation. And basically what the Economic Innovation Group did is they found census tracts all across the country that had weak market fundamentals as far as area median income, access to capital, right? And they used various metrics to come up with this. And then when they passed the legislation, the Opportunity Zone legislation allowed investors to be able to go in here and invest, roll their capital gains into these communities, right? In exchange for tax deferral as well as complete tax gains mitigation. So we'll go through the mechanics of this, right? So the first thing is you have 180 days from your capital gain, from the recognition of your sale. If you're part of a partnership, that goes to the end of your tax year. So your 180 days starts at the end of your tax year. But you have 180 days to invest in the fund, okay? Fund is really a misnomer because it can be what they call a single asset fund, which means I find a deal in an opportunity zone, okay? I can just myself set up an opportunity zone fund, or I can set up a LLC and recruit others outside capital, but we're only purchasing one asset, right? Whereas a true real estate fund structure, typically through a sponsor like myself, someone's giving me their money and then we're going out and purchasing 1, 2, 3, and 4, 5 properties, right? So small distinguish that the fund is actually kind of a misnomer, right? The way that you have to comply is once you place your money within that 180 days, you have 30 months, okay, to increase your basis. Okay, that's a very technical term. I'll go through this by 100%. Basis means if I buy a property for, so I'll call it $100,000 for you, and we assign $70,000 to the building, $30,000 to the land, I have to improve that building by $70,000 to qualify for the property, or excuse me, for the tax deferral. Okay, so the reason Opportunity Zones was structured this way, a lot of people ask me why. Well, they didn't want people going and speculating on existing building stock. This was meant to drive development, right? That's essentially what it was for. So you don't see a lot of Opportunity Zone funds and sponsors doing value add deals. We're doing some value add deals that are adding significant amount of CapEx into these projects, call them little mini developments in some instances. But it's essentially catered to more of the developers, right? And so the way that it works, you defer your capital gains to the year 2026, okay? So that initial capital gains that you have, you defer to 2026. You pay that capital gains in 2026. I believe right now you reduce your capital gains liability by 5%. And then any additional appreciation, let's just say you had $100,000 capital gain, you invest, you defer it, you pay tax on it in 2026. Let's say at the end of 10 years, you have to hold the investment for 10 years, you go to sell, and now your property is worth $300,000. You pay zero capital gains on that $200,000. So again, it's an encouraging investment in these communities, holding it for the long term, and then completely mitigating the capital gains, okay? There's two big caveats that I want people to be aware of, right? Everyone says, well, 10 years is a long time. And we've heard investors say, hey, I'm older, I'm getting up in age. I could be dead by then. Like 10 years is forever. And some people get a little uncomfortable with that trajectory. So let me just hit people to two things. The first is most development projects, most investors that you're investing with, they have what you call recapitalization, right? Which means that we're going in, we're developing an asset, we're leasing it up, or we're repositioning this asset, and you have a recapitalization. It means you're going back to the bank, you're putting stabilized debt on the project, and you're typically returning money back to the investors, okay? For those of you who have already done real estate syndications or funds, very familiar with this process. It's a great way to return capital back to you, and different sponsors handle it differently. So there's a liquidity of it in there, right? So you're protected usually, and that usually happens within a 2 to 3 year time frame, if not sooner. So you're not having to wait for this, 10 years to really understand the benefits. The second thing is that if you sell that asset or liquidate that fund, well, we'll just do a single asset. You have 12 months to reinvest in another opportunity zone deal, and then your time frame just starts over. So essentially, you could work it just as you would a 1031 and keep rolling down the road, right? If you didn't want to hold for 10 years, or someone gives you an outstanding price for your asset, you don't have to say, well, man, I got to wait 10 years to sell it. You can sell it. You got 12 months then to roll in. Again, way more flexible from a time frame perspective. And as Brett and I have talked about in our side conversations, we're getting more and more people, and this is a strength, so we're already kind of running into this, where people are falling into 1031s, they're missing their 45-day window, but now they've got a whole nother stretch of runway, right, from that 45 to 180 days for an op zone deal. And if they've reached out and touched base with multiple sponsors, diversifying into multiple OZ deals, now they've got a whole slew of options, right, from 45 to 180 days. And the last thing I'll say is that there's a lot of misconception and perception about these opportunity zones. I would encourage anyone who's investing in this, don't tag these as like the war zone, class D areas, right? Most of the opportunity zone areas that we've seen, they just suffer from low area medium income, but they've already seen a massive influx of capital, right? These are up and coming areas already. And so there's been a lot of talk about the risk profile of these. I would just say, don't judge a book by its cover.
Now, always make sure that you're not letting the tax tail wag the investment dog, right? And there are a lot of dogs out there for opportunity zones, just like there's a lot of dogs out there for highly appreciated 1031 exchange or Delaware statutory deals. So timing and the business plan and the deals, and so let the opportunity zone be gravy to the deal that you were already going to be putting into, and you already had that. And so just be aware of that, right? And so, yeah, that would be the last point, but everything else was spot on what Matt was saying.